Markets fall for the fifth straight week amidst Trump's tariffs, which is the longest losing streak in 2 years. More than 35 Nifty stocks post losses this week. All sectoral indices slip, with realty, defense and metals leading the fall. The only exception was FMCG, which gained. Hello and welcome to this edition of Editors Roundtable. I am Reema. With me are Prashant and Nimesh, and joining us here in the studio is Prashant Kimka, founder of White Oak Capital. Hi guys, what a week. Lots coming in from Donald Trump, earnings.
Yeah, and big shockers, right? Every day we had one accident this week. Today was a classic example of PNB housing down 18% on MD resigning. So this has been a difficult week. In fact, it's been difficult months, Prashant, right? I mean, it's been challenging even for investors. Forget about traders and all, they're not making money. But at a portfolio level, are you seeing now a bit of fatigue?
Fatigue from investors investing,
yeah.
Is it? See, it ebbs and flows. I think last quarter was pretty solid quarter. Yeah. July, as you pointed out, has been weak. If it sustains over a prolonged period of time, you start seeing the impact. Now, it's coming up to 12 months when investors would not be making any return.
I was to come to that point that now it's almost a year that, the returns are negative for the last 1 year investors. So in that context.
So it'll be interesting to see.
Yeah.
My gut feel is that you might see some moderation in the appetite for investment in mutual funds if 12-month returns, when they see in a couple of months' time, are negative.
Yeah.
That's just how the investor psyche works. Yes. But we'll
and that's not been a trend for the last few years. So, it's kind of a shock, right? I mean, if you're not experienced for 3 years, 4 years, and immediately 1 year you see negative returns, people get shaken out, right?
True. The expectations last year around this time were so ebullient. People were like 15 to 20%. Rarely would you find people who will say 15 to 20%.
Yeah.
20 to 30% was kind of become like an expectation that this much, so at least
Mil hi jayega.
Yes. At least get. Because since COVID, that's in such a sharp
15, 20, 25, I'm confused. Were you talking about Trump tariffs or market returns?
They were escalating like Trump tariffs. Yeah.
But I want to put out some
reality
numbers.
Check. Ab de do.
But Nimesh, the point is, we've been kind of slowing down in terms of returns for a while. Yeah. And now we are, it's just coincidental that you're coming to a point, which is H2 of 2025, where any case, expectation is that all of this Trump tariff tomato which has happened will now finally start to really show up. So far, it has actually not shown up, right? So India has been slowing down on its own account. US, etc., has been doing very well. So you are now, after coming to a point, already slowing down, where now perhaps in the US also this will start to show up. And actually, the graphics will come up for our viewers. There are two reasons why many are saying this will show up now. I mean, these tariffs have become reality. Because at some level, people were kind of wondering whether ye hoga, nahi hoga, really 20-25%. Yeah. Right now, looks like it's going to be 20%. Average tariffs are now, most economists are saying between 18 and 20%. There are two reasons. One is, before these tariffs hit, there was a lot of front loading into the US which happened, right?
Yeah.
So basically, they didn't have these tariffs, so consumers didn't feel any impact. So no inflation and sentiment, etc., was higher. Second is that companies themselves did not know what's going to happen. And I spoke to, for example, Raghuram Rajan and a few others who are there in the US. The companies they have spoken with saying we're waiting to see where these tariffs settle at. Yeah. So they did not increase prices. Now that they also see this is going to happen, they will start to pass some of these prices on. So my short point is we've been kind of suffering without the globe. I shouldn't say suffering. We've had 3-4 good years, but we've been slowing down. And now maybe the world joins us, Prashant. Is that
I would say more than slowing down, I'd say normalizing. Yeah. The past 3-4 years weren't normal. 20% return isn't normal. If you look at last 20, 30, 40 years, so an average out and adjust for inflation, obviously in the 80s and 90s, inflation was a lot higher. So the nominal GDP, the GDP deflator was higher, hence nominal GDP growth and corporate sales and profits were accordingly higher, and then hence the return a little higher. But if you look at last 20, 30 years, the returns are in line with nominal GDP more or less.
So in India, dollar returns are I think 12%.
Depending again where
12.5%.
the starting point. If you start March 20, it's very different from December 20 or March.
No, I'm looking at 25 years.
Yeah, 25
Last 25
years.
years, it's 12 dollar returns is 12%.
So that's a little, I would say, higher than what we should expect going forward. Our expectation is if we get 12% rupee return.
You're saying 12% is higher?
Yeah, dollar return is very high. 12% is unsustainably high. And, it probably, I'll have to see what starting point particularly we are taking, whether it's fiscal year or calendar year also can make a difference. I'll say nominal GDP growth in India would be 6 plus 4 or something like that, or 5.5 plus 4.5 something. That's a little over 10%. Add dividend yield of 1%. Pre-tax, so I say pre-tax double digit, ex-tax, post-tax high single digit rupee return is a reasonable expectation to have going forward. Sure. And for dollar returns, you shave off 3 percentage points to 3.5 percentage points. So around 6.5, 7% is a reasonable return to have in dollar terms.
Got that. Off late we're seeing a lot of interest in REITs because now the expectation from equity itself is moderating. A lot of the companies which are sponsoring the REITs is saying that anyway you're getting a dividend yield of 6-7%, and this is a very efficient way of returning. I mean, from a tax point of view, it's efficient. Plus, there will be some capital appreciation. So, it's quite risk-free to assume a low to mid-teens kind of a revenue growth. Should one be looking at REITs as an investment avenue?
No, sure, Rima. I think very important point. REITs, our team is quite positive on not just REITs as a sector, but they are finding many more opportunities in there, even though the sector is fairly small.
It's small. We've just got 4 and now 1 will come up.
Absolutely. So the team has a disproportionate allocation, I would say, in REITs. And yes, the valuation is attractive of several of these companies. And that is because there was this disenchantment for a variety of reasons, including 13-14% return or 12 to 14% return, no big deal. We don't want to settle for just low teens kind of return because the return expectations from equities were so much higher. As you recalibrate return expectations from broader equity market, quite possible these on a relative terms would start looking far more appealing. Beginning of the year when markets, were down high single digit, double digit or so, the REITs actually were outperforming that time. Because not simply because people were rushing in to buy, but the valuation to begin with was very reasonable.
These instruments you should buy when interest rates are very high, right? That's the time to buy because yields will be high. I mean, are we at that? Have we kind of? Does that make a difference? The buying point.
So we generally don't necessarily, follow these interest rate cycle and their correlation with, specific sectors and all. Or
No, not correlation.
Tend to underplay those. But even if you were to think about that,
because it's a quasi-debt product, essentially, right? I mean,
see, growth is also very important. As Rima pointed out, the growth element is also very important because these guys, the growth in rental yield or rental growth would only come if there is a stronger growth. So if interest rates are falling because growth is slowing down and hence the rental inflation is likely to be lower, then that could be a negative factor. So there are competing factors on that one, but all else equal, you're right, but all else is rarely equal, but all else equal, you're right, and inflation rates are expected, interest rates are expected to.
I remember we had.
Ramdev.
No.
Ramesh Mantri.
Ramesh Mantri was
there. He was one of the big bulls.
Yeah, he is very bullish.
Very bullish.
Yes.
So next week we'll have Knowledge Realty Trust, which will open up in terms of an IPO, and that's backed by Blackstone and the Satva Group. So that's going to be a big one to watch out for. They're looking to raise about 4,800.
So that's the fifth REIT.
That's the fifth REIT.
We have 4 listed.
We have 4 listed.
3 are retail, 1 is commercial.
3 are commercial.
3 are commercial, 1 is retail,
which is Nexus, and this would be the 4th one, Knowledge Realty Trust. But just to quickly, if you thought this was an action-packed week, next week is going to be equally action-packed, and we're beginning with 5 consecutive weekly losses. So, this week we've lost nearly about 1% on the index. But in the August series, typically, at least in the 3 out of the last 4, the markets have gained. So next week, we've got the RBI policy, 6th of August, and plus 7th of August. That's the D day right now, 25% tariff on India plus penalties unless it's negotiated in the next 1 week. And in terms of big earnings, you've got DLF, Bharti, Bajaj Auto, Trend, Titan, LIC, SBI, Tata Motors. So the hectic earnings season will continue.
Prashant, now that we have enough clarity on the tariffs, certain sectors impacted the most, right? We spoke about textile as one space. Pharma, you liking some of those pharma names, but even those got hit very hard today. Now that we have a clarity, which are the sectors will be an avoid for you, and which is a sector where you feel there could be bottom fishing?
Certainly. See, first of all, if one manages any amount of sizable corpus, you can't swing the weights on every, otherwise, since the first announcement of tariffs, you would have already switched in, switched out a few times.
But now that we have clarity, now there is enough clarity on the...
Do we really? Do we really? Because this is his negotiation style as well, right? He ramps up the rhetoric in the final moments. So who knows, a week from now, maybe this is what the final outcome is. But let's assume for a minute, to Nimesh, to your point, if this is the final outcome. So within healthcare is a very broad segment. For example, hospitals in India aren't impacted. Diagnostics aren't impacted. Even in pharmaceuticals, only if you have a predominance. First of all, these tariffs are not applicable as of now.
Pharma, exactly.
Pharma.
Still, the market is very sharply.
Just worried that if his posturing is harsh against India, could there be though there are political compulsions within US on pharmaceuticals, which may restrain him on that front. But let's assume even that the tariffs would be similarly high on, let's say, pharma as well. But then it impacts predominantly those who have, if that were the case, huge exposure to the US. There are several companies who have de minimis exposure to US, if at all. So very, mixed picture once you start going to the stock level. And that's how we would evaluate each opportunity.
I just pulled up this. I wish we could put this up. There's a gentleman called Marco Papic. We speak to him on global stuff. He says he's put out this nice graphic: 7 steps of maximum pressure. Trump's negotiating style. Number 1, ask for the moon. Number 2, when the world scoffs at your demands, threaten them with fire, fury, and whatever else. 3rd, punch someone in the mouth. It's number 3. 4 is break bread, make friends. Number 5, leave the bride at the altar. 6, kiss and make up, and then make a deal. So I don't know. Where are we? 5th or 6th or?
I don't know. I don't know if you've seen the movie The Apprentice. It's a... I don't know how real it is, but it gives you an insight into the character. It was really...
You've lived in the US though, right? I mean, Prashant, I mean, he's a New York businessman, right? He likes to make deals. He likes to... that's the style. He's...
Yes, I think we've seen it all over the last, particularly in this term. So, in some sense, the essence is his... at the heart, he's very unpredictable. And he likes it that way. He's no ego, so he can chew his words the moment he's spoken them. So in that sense, it is predictable.
Predictably unpredictable.
Yes.
But Prashant, assuming for second half, as where we are in terms of earnings, in terms of tariffs and whatever, which are the things which will make you bullish for second half of this year for Indian markets? Because, one of the argument is that India is an expensive market, and now with these tariffs and everything, the safe haven status will go for India, at least for the near term. In that context, as a fund manager, what will make you bullish? See,
this expensive argument, I don't buy.
It's been there for many years. Right?
It's like,
it's always been an
XYZ consumer staple stock has always traded at 50p multiple. It's always been the case and likely would remain the case.
True.
Because there are certain underlying reasons. It's not like...
so the argument is, forget the expensive part.
So it's not expensive, but to your point is still...
But what will make you bullish? I mean, what are the few ingredients that you're watching out for?
I think it will be quite possibly, as I said, a normal market. Which is a blocking and tackling market. You earn 10% in the market.
Sure.
And you try to make...
So basically, lower your expectations for this year.
That is normal expectation. I think going forward, a 10 8% return expectation is pretty normal expectation. 10 to 11% rupee expectation. They're very normal.
Prashant is talking about REITs. That should give you a signal, Nimesh. What his view on equities is. I want to ask you a question, and the graphics will come up. The broader losses this week, that one, big cuts actually, Nimesh. PNB Housing was down 20, of course, all thanks to Friday. Home First was down 20. IIFL was down 17. Five-Star Finance was down 13. Indocent, of course, has been a casualty for a while, 12% lower. It's a...
Certainly. And just to Nimesh's question, like, look, 2 years ago or a year and a half ago, let's say late 2023, the environment for financials, lending institutions couldn't have been rosier. Growth was very strong. NPLs were at cyclical lows. Post-COVID, over-provisioned books, and everything was beautiful. At that time, the question, to your question, it would have been very easy to say that financials are a place where you can expect 20% kind of growth or so. So that turned out to be the other way around.
Yeah, true.
In real world, in that sector. Yet there is a dispersion in the stock performance. Year-to-date, financials is still one of the better sectors.
By the way, it still routinely comes up as when we ask people that financials is the place.
You have to invest. We are ourselves the largest allocation,
right?
but the conditions presently may be challenging, but that may be also potentially, who knows, the bottom. If the economy does not, and there's no reason to believe it would nosedive or anything, even if it stabilizes, then it could be, we could be scraping somewhere around the bottom on the NPL zone. We'll only know with the benefit.
You've got the RBI, by all accounts, senior bankers have said that they are asking straightforward, what do you need to kickstart growth? So there is that push is very, very clear.
Absolutely.
So that tailwind is there, right?
It has reversed in the last 9 months.
Completely reversed in terms of the tone and tenor. I think we'll take a quick commercial break here. Let's do that. We'll come back. Prashant, of course, is with us, and we'll continue some of the conversations.
Welcome back. You're watching Editors Roundtable. We're in conversation with Prashant Kimka, White Oak Capital. We've been discussing how the tariff uncertainty has been hurting the Indian market. But Prashant, if we have to expect a 10% kind of a return from here on, where do you make that kind of money? And also tell us a little bit about tech, because in the past you were fairly optimistic, but I think you've been bringing down your exposures.
Certainly. So within tech, you're right. Overall exposure in the portfolio has come down. But it has actually increased in certain areas like software products or mid-cap IT. It's probably held stable or up slightly, but most of the reduction has been on the large-cap names in IT. We already were less invested in large caps, but have taken down somewhat further. Now, new age tech is very much there and has increased over the prior. In fact, the so-called new age tech is now possibly larger, not possibly, is definitely larger in the portfolio than the traditional IT services name.
And large cap tech is practically nil now?
Much lower, very, very little.
Minuscule now.
Prashant, what about the QSR, or for that matter, the Zomatos and Swiggy's, the platform businesses, so to speak? You've looked at so many businesses globally as well in your GEM portfolio globally. In India, how do you value them, and are you been bullish on that space?
So see, value them the same way as anywhere else in the world and any other sector. So over the last 8 years, let's say, they've always been a sizable part of the portfolio.
Okay.
Obviously, 22 was a very difficult year for them, and some of 23 as well. And that's what I was referring to when I was saying new age tech. Not all of these new age tech companies are necessarily new. Some of these have been listed for a while. So collectively, these companies are a fairly significant, the way our portfolios are structured. We never take crazy thematic bets. But within that context, we have fairly sizable investment. As I was saying, I just realized they're a bigger component of the portfolio than the traditional IT services
Zomato itself is what now? 3 lakh. What's the market cap? 3 lakh.
Which one?
3 lakh. Zomato.
Zomato market cap is more than 3 lakh.
3 lakh crores, right?
3 lakh.
So that's
So it's expensive. But again, it's so much of growth. In fact, today Swiggy, despite such a large loss, everybody is today on the sell side has upgraded the stock to a buy or a neutral. They've raised the target prices. So everybody feels it's a last quarter of big pain. In that sense, a lot of analysts are also bullish as well.
See, if you look at these stories may appear new and first time in India.
Yeah, absolutely.
But the story has played out across the world, country after country.
Which is why I asked you, because in your previous role as well, you've looked at so much of emerging market companies globally.
Absolutely.
That would have been easy for you to take calls on the likes of Zomato.
Absolutely, that has certainly helped, and that is why in some ways we've had exposure to these companies long before they went public also.
Yeah.
And if you look at forget US, which this whole thing started in the late 90s. But even over the last dozen years, if you see China, Korea, other ASEAN countries, the same story has played out. A lot of these companies, start the business, and these companies are more or less copying for most part, though some elements, like you said, quick commerce is more, India is where it has started.
But this 10-minute is nowhere, right?
Yeah, so far, I think it will get copied from India, but this is...
And now the 10-minute delivery is larger than the food delivery.
Yes, in GM, depending on how you measure, yes, that is larger in terms of volumes, if you would. But it has, other areas have started, other places, they've started copying to some degree. But these companies from across, if you see, initially a lot of players start, a few gain the scale advantage. There is consolidation because a lot of players then just shut down, lack of funding, whatnot. And then one or two emerge to dominate those segments. Yes, they always face tech challenges and new...
I think in India there are three which are there, right? It's very clear. Zomato seems to be very strong in North.
Others can come in, and there is no entry barrier now.
But emerge, what Prashant is saying, eventually we will... but there is Zomato very strong in the North, Swiggy, Bangalore, Bombay, etc.
Correct.
And I think there is Zepto, which is also strong in the West, I think.
In most of these businesses, the threat, in my assessment, globally also we've seen, is likely to be new players using some kind of a new novelty.
Yeah.
Rather than existing large players. Like in Korea, Samsung hasn't been successful, for example, in dislodging the new players. So in China, it isn't some incumbent of the old economy necessarily who's been successful. They've all tried, but it's usually the new disruptor who's been able to.
I think delivery by drones. I think we've done.
The other interesting thing I want to ask you was, a lot of money is now shifting to the unlisted market or the pre-IPOs and, that space. You're also launching a CAT 2 AIF. Late in the game, early in the game, where are we right now? Because I can sense a lot of money chasing very few deals in the private market space now.
I won't say, see, when we started the asset management company, also in 3 years ago when we launched, I said, you are 43rd company, aren't you late? Give the example, there are thousands of asset managers in US, right? Yes. So 20, 30 years down the line, we'll say we were the 43rd AMC, like we were one of the earliest. 50, yes. We were top 50, earliest 50 asset management company. So that's how in, unlisted space, we are at very, very nascent stages right now. Yes, with benefit of hindsight, could we have started a few years earlier? Yes, but it's never late. And the opportunity set, it's so huge, you can't, not everyone can...
What excited you to get into unlisted?
See, we were already doing so. For one of our funds for last 7+ years, we have been investing in, I would say, pre-listed segment. And very strong, I would say, experience, very positive experience for us. And several of the team members had been asking for it. I think it was my hesitation that delayed it for this long. But I realize it's a very attractive opportunity for us, for investors, and hence we launched it a couple of months ago.
Okay, for me, I think the big takeaway is that your exposure to the new age platform tech companies is more than that of the IT services as a whole. And even in IT, it's the mid-cap platform companies that you like and you're attracted to. Well, curtains down?
Curtains down. We'll say thank you to Prashant.
All set for the weekend?
Thank you. Yes, looking forward.
Thank you, Prashant.
Thanks very much.
Thank you very much for coming. Well, with that, we thank you for watching this show. Stay tuned to CNBC TV18 for more news and updates. Goodbye.